Okay, welcome everybody to a special Wall Street Reporter Next Superstock live stream. We have a returning company, I don't want to say a former Next, but one of our former companies, which is still, I think could be going on to great things. And the format for today is the interview is going to be done not by me, but by special request, a major shareholder, Mr. Sean Black, the Warren Buffett of Canada, the Elon Musk of Canadian penny stocks. Sean Pratt, welcome.
Hey, Jack.
Hey, Jack.
All right, so let me get the server. Yeah, in case I'm going to have the little things over there. Sean, just before we get started, okay, if you could, I just want to make sure you tilt the camera down a little bit so we're all the same. A little, just a sec. Okay, there we go. Perfect. Okay. So basically, I'm going to turn it over to you. You're going to be doing the. I'm going to maybe pop back for Q&A.
Sure.
And again, the main idea today is, and you guys have an hour, right? We have an hour till 3 o'clock Eastern, and we have. Don't beat up Pratt too much.
Jack already did that before the call started.
I gave him a little bit of a beating. I said that, how important the retail audience is, but he's showing up here, so obviously there's an interest in engaging with retail. And look, I mean, we all want to see the stock at $20-$30. I'm a shareholder myself, so I'm very biased to seeing this at $100 plus. Pratt, it's up to you to make it happen, though. So
that would be my job, Jack. Yeah.
That's it. Let me.
I think that's the only thing I'm sitting here trying to do.
Okay, guys. Okay, so Sean, take it away.
All right. Thanks, Jack. Hey, Brad.
Hey, Sean.
Thanks for doing this today. I think it's great for all shareholders. It's great for Jack. Great for yourself as well. I think it's good to reconnect. And touch base where the company's at today. But and one thing that's important, I think it'd be crazy of us to think that everybody knows the story as well as I do, or as well as some other shareholders out there, because a lot of people are still new. I still think you're still a baby as far as going on the NASDAQ goes. There's a lot of people that don't know the story. So what I was going to ask today was, we sort of do a past, present, future. Kind of tell me where you and Cash started, where you're at today, and who you want to be when you grow up. Because I think that's, at the end of the day, I think it's important to know where you came from, and then what's the path forward. And I'm hoping today you could share that with myself, the shareholders, because I still find every time I come on here and every time I speak to you, or watch one of your events you do, I still learn something. Even when the new investor deck went up recently, I was learning. So. If you don't mind, I'll let you take it away, but kind of give us that 360 of you and the company.
Yeah, I appreciate it, Sean. And again, likewise, thanks, Jack, for having me back on here again. And look, it's always helpful, Sean. You and I chat, and you're always a good voice for kind of seeing where the market's at and where retail investors' heads are at. And we do our best to try and answer those questions, but there's always more context that can be given. So I'll kind of kick it off with a bit of a background. So for those who don't know. Myself and Cash Koresh were both the co-founders of Skylight Health. And funny enough, Skylight Health was one of the original companies that Cash and I first started working in back in sort of early 2010. And so prior to Skylight Health today, both Cash and I have a background in clinical practice management. And so we've been primarily focused on the Canadian market, but most of our work has been in owning, operating, and running primary care facilities. When I say primary care, I'm talking about like family medical clinics, internal medical clinics, subspecialty clinics, and then Cash has had more experience on the allied side, like pharmacy and chiro, physio, etc. And so we kind of came to the U.S. market a little bit through a side venture, which was a data analytics business that was really designed on the capturing of data and information that
sale, right?
Yeah, sale, which actually, interesting enough, became in the medical cannabis space, which Cash and I knew nothing about. And we got approached by a number of our physician clients in 2014 who said, now that Canada has required physicians to write a prescription for medical cannabis, they need to be educated on how to do it. And so we thought we would go ahead and collect real world data, build data into decision support tools, and then have that commercialized for physicians to use. And we bought these clinics in the US that were specializing in medical cannabis certifications. They were one of the largest ones at the time. we continued to acquire in that space and actually built a really large network of practices, which was doing phenomenal things, by the way, in helping patients who couldn't be served through traditional pharmaceuticals using alternative methods like medical cannabis, which now, by the way, we just recently announced news last week that we're going to be divesting off of that certification business. Because one of the things that happened through the course of the evolution of that model and the evolution of our technology was we recognized that medical cannabis is really part of a broader holistic treatment. It's part of primary care in general. But treating it independently on its own is not really going to help patients directly. You need to control their other medications. You need to control a lot of their other care. And so having experience in primary care, having experience in running clinics, Cash and I sort of shifted the focus of the business to say, look, long-term, whether it's medical cannabis or other forms of other types of nutraceutical products, you need to own the primary care network. Once you have that, you have a better chance of integrating other therapies and treatments. And about that time, we started looking into what was happening in the US market, especially around primary care and the types of models and the reimbursement models with health insurance companies. There's a huge difference in the way physicians get paid. In Canada, it's a provincial system. You get paid by the government. It's fixed fees. In the US, it's health insurance companies. There's fluctuating rates and the way that they earn revenue, et cetera. And so we were really enamored by the way that, you could run effectively a profitable business in the US, where running clinics in Canada is really tough to be profitable. And you could run a profitable business in the US, but at the same time, you could really kind of expand services to patients under this shifting reimbursement model that's taking place. And we'll talk about that. But effectively, we could take our experience that we had running clinics here and then shift our focus to the US market using the infrastructure of what we built there. And then a lot of the technology that was developed as part of SAIL is actually very complementary to what we're trying to do within the primary care space, which is effectively trying to understand our patients better, their health, their history, and then impact each patient individually so that you get better patient outcomes and better quality of care. So, kind of 360, we brought the business back to primary care again, except shifting it from a Canadian focus to a US focus. And, we've seen a lot of success and a lot of validation of our thesis from both a consolidation format where, we're acquiring practices, we're integrating them, we're centralizing them, and then ultimately we're now starting to shift how those practices get reimbursed so that we get to be in more control of the healthcare dollar for our patients. And
Brad, would you say, what was the biggest, from there to that part you started at to here you are today, what did you learn? And what would you do? Anything you do different or anything you're taking from there using forward? Like one of the pieces I understand is you didn't sell the tech though, you just sold the license, right? So or to the asset. So in your sale, you still kept the sale tech as far as I understand.
Yeah. The technology has stayed with us. So what we divested or will divest when the deal closes is effectively the service arm to the business, which is the brick and mortar facilities where the physicians and the patients interact for the pure purpose of getting a medical cannabis certification in those states according to those state laws. The tech itself may continue to be licensed there with a new organization taking over, which is a great organization, by the way. But the core aspects of the development, the technology, the IP is still remaining with Skylight Health. And like I said, has already been repurposed to a certain extent, but a lot of that technology continues to be evolved into where we're driving on the primary care side.
Okay. So that's a good, history lesson. And that brought you to today, right?
That brings us to today. Yeah.
Yeah, to today. And in that business, like, I've been with you, in the ride when you were private, to, all the way down to, I think you were on the phone when it was 6 or 7 cents. And then, just about started popping champagne, when it was, $1.90. And, in that journey, the welcome mat and all the pieces that you've done, I still believe there's a major disconnect because I believe the average investor, and I was one of them, that didn't understand the pivot, right? They really don't understand, what you were moving to at value-based care. I don't think they understand what that is or what the size of the prize is. So if you could maybe just, share the landscape as to, what you're chasing. Like, okay, so here's where you are today, but this is what I'm building. And this is where we are today, because I use that line quite a bit, but, the business, isn't the stock isn't the business or the stock isn't the company, the Jeff Bezos line. And, I wanted to understand what you're building, because, when you talk about bricks and mortar, you talk about what's going to be here long after the share price is done, being manipulated or being moved around. where are you going with it? What are you trying to get to? What's the size of the prize, value-based care, and what's the competitive set look like in that category that you see today?
You know, I had this conversation a few times with a few different retail investors, right? And look, I don't think I'm taking our eye off the price. Skylight, in our opinion, will be $1 billion revenue plus company, not valuation, revenue company plus in the next 3 to 5 years. And I feel very confident about that approach. You know, that's largely based on numbers and metrics and models that already exist today, and that a lot of our bigger peers who have taken 5 to 9 years to build have validated that. And so, you know, our biggest not biggest, but one of the largest players in the space, Oak Street Health, took 9 years to get there, and we think we get there in 5. They did it organically. We're doing it by acquisition. So let's take a.
So how far in the 5-year journey? How far are you now?
So let's say this is end of year 1, right? So we're starting kind of year 2 next year, right? And so for us, you know, so let's take a step back and kind of say, okay, well, what does that journey look like, right? Because I think you're right. There's this notion of value-based care, and people may or may not fully understand what that is, but what is Skylight doing in the meantime? So, you know, I think we need to bring it back to sort of the basic roots of where we were a year and a half ago and where we're starting from now, right? So at its most basic core, Skylight Health is building a national platform of primary care practices, right? So, you know, we are in the business of brick and mortar services and technology, telemedicine services to patients, providing family medicine, internal medicine, urgent care, subspecialty care in the US, right? We are aggressively growing. We are growing primarily by consolidation, right? So we sort of have 2 legs to our business. The first leg is we are a consolidator of fragmented primary care practices, where in the last 12 months, we've already made 8 acquisitions. We've brought in over $35 million in annualized revenue. We've acquired more than 100,000 patient lives. We employ more than 100 physicians and providers across the US today, and operate out of 5 key markets today across the US, right? So we have very quickly shown that our capability to target and acquire practices generates strong growth year over year. 2020, we exited the year with $13 million in revenue. 2021, we're forecasting an exit of $41 million in revenue. And then we believe that growth should continue in the coming years, just based on this pure consolidation play.
What was the year before, Pat? So you're targeting 41. What was the year before?
13 and change.
So 13. So you went from 13 million to 41 million. Okay.
Yeah.
So now I understand why everybody's pissed at your share price. Okay, keep going.
Now, when you consider the growth of the business, let's just focus on the consolidation play alone for a second, right? Because that itself is a very strong proponent of growth. And here's why. The primary care market's highly fragmented. We kind of said this at the beginning, right? We're solving one major problem in the primary care space, and that is that independent primary care physicians today, of which there are hundreds and thousands of in the US market, do not have someone to sell their practice to. And you've got physicians who are retiring in the next 5 to 10 years. You've got physicians that have been hurt because of COVID. You've got physicians that are going, hey, when I started my practice 20 years ago, I only used to spend like 10% of my time on paperwork and administration. But because the healthcare system is so complex today, I'm spending like 60% of my time. I just want to go back to being a doctor again. And so these physicians struggle to find qualified buyers, right? There are buyers in the market, but I wouldn't say that they're necessarily all aligned for what that legacy that physician built a practice for. So when we go into a market and we acquire a practice, most of our referrals, in terms of most of our pipeline, is built by incoming referrals. So we actually haven't spent a single dollar on going out and sourcing a deal. All of our deals have either come in through sell-side brokers, or they've come in through clinics who've said, hey, I heard you bought a clinic in my neighborhood. Would you be interested in buying me? Or one of our physicians that we've acquired their practice of goes and talks to some of their friends, and then they help us sort of identify new potential opportunities there. So for us, the idea that there is a very strong demand of practices out there today, and there are very few buyers of those practices out there today, even if there were more buyers, allows us a pipeline of deal flow that opportunities is not really a concern for us, right? Now, why this is attractive in terms of an opportunity for acquisition is because, again, while there is a strong demand, there's not a lot of people who want to buy these practices, right? A primary care practice today is not a high margin business when you think about like subspecialty, right? You're looking at an oncology practice or an endocrinology practice. And typically the buyers of those types of businesses are private equity. And so private equity is not really focused in primary care, right? Because the margins are not very large there. The reimbursement models are also a little bit more traditionally old. They're fee for service. And what's happening in the US today is the way doctors get paid is shifting. And if physicians have not shifted to that new reimbursement model, there's work to be done. And new buyers don't necessarily want to put in that work. They kind of want to buy the finished product. So you're ending up with a total addressable market of practices, which is very large, where the attractiveness to buyers is very low. And so the multiple upon which you can buy these practices for is fairly attractive. That's not to say that the physicians are losing out on anything. I think they get an opportunity to participate in more upside with Skylight than they do by themselves. But we as Skylight get the benefit of finding attractive opportunities for growth. And so we buy these practices at 3 to 7 times EBITDA, but really it works out to an average 1 or less than 1 times revenue, right? Some will be more, some will be less.
And that's what you're sort of setting up in year one. You sort of set
We did.
the foundation for that. In my opinion, you've demonstrated that you can do it.
And that it'll continue to happen, right? And that I can speak with a lot of confidence that acquisitions for us is something that will be ongoing and continuous. And that's why year over year, quarter over quarter, we're expecting that we're going to be able to continue to show growing revenues. And
obviously, I understand the consolidation play for sure, Brad, and it's new.
Yeah.
It's more of a U.S. thing, honestly, than it is in Canada. In my world, there's MTY and Recipe, 2 restaurant companies out there that do that. MTY has been great at it. They're taking the stock from 30 cents to $70, and acquiring businesses, and just consolidating them and going forward. But what I look for, one of the keys that I wanted to know was, when you buy it, what's the timeline that you typically experience for integration? So it's like, until it's really yours and it's humming, and you've brought in your technology, you've brought in your team, like what's the run rate look like to get it to that point where, okay, now we're happy with it. So like after you acquire it, what's the target timeline to make it your own? And
yeah, I mean, look, our ideal timeline is 3 to 6 months, right? It should be closer to the 3 months than the 6 month mark, and that depends on the type of practice, size of practice, and call it stage of practice, right? Where they are in their life cycle. But typically, we look at kind of core components of our business, whether it's your EMR system, your electronic health record, or your HR, payroll, finance, the main structures of a business, right? That's all centralized at Skylight. So I'd say about 3 to 6 months before we see most of those functions taken back to a centralized manner, and then operations decentralized down to a clinical level. And that's really kind of setting the foundation for these practices for the next leg of growth, which is this whole reimbursement shift.
Okay, because I do recall in your last quarter of your report, I think it was like 13% you experienced,
right, in organic growth.
Organic growth, right? And
yeah,
I don't mean to be offensive to anybody else out there that's in the business, but that's what I'm paying attention to. Because do you buy it and you suck at it? You know what I mean? When you operate, or could you buy it and help that business realize untapped potential, right? Because if you told me you weren't improving margins, you weren't even getting any organic off those businesses, and now I've been watching you do it for roughly about a year. Like you said, you're in that year one, so I was really focused on that number, because that's, to me, that dictates, is the management team, do they have a clue what they're doing? You know what I mean? Because if you keep buying
right.
stuff and you suck at it, and you're closing clinics, or your same store performance is down. I same store, but same clinic performance is down. I'd be like, your model sucks. Don't believe a word these guys say, because they can consolidate, but they can't operate. Right.
Right.
So, so before you give someone another check to say, go buy more, I want to make sure the ones they bought in the first place, they're healthy,
are working.
You know what I mean? The organic numbers are there, because a lot of people can say we're going to run an inorganic and organic business, but they're full of crap, because if you drill down on the actual business, they suck at it. So they got to buy more to cover up the friggin' mess that they create every time they buy something. So anyway, so I think it's important to highlight that part. I don't think you guys did much of that last time. Everybody wants to talk about new, but that's the most expensive business, is the new, right? So what can I get out of this one? Can I squeeze more juice out of it? Can I be a better operator? Can I demonstrate to those people they're going to sell to me that every time I buy it, I'm going to actually improve it?
Right.
I'm not going to kill it. You know what I mean? So, so as you go into year two, what do you see? Like, as you go that 2 to 5 year plan, what's that look like now, year two? And I know you're not in year one, but what do you think for year two?
So, I mean, look, year 2, year 3, year 4, consolidation will continue, right? So we'll kind of move on from that piece. And so expect Q over Q growth on that side. I think the other reality is, sort of to your point, Sean, like, what do these clinics look like in 2 to 4 years, 3 to 5 years after we buy them, right? And this is where it gets really interesting, because you're right. In a true consolidation story, you're getting revenue synergies, you're getting cost synergies, you're generating economies of scale, you're increasing margins. And that is true to a certain extent in these clinics. First of all, a lot of these clinics are run relatively lean, right? And so that is true to a certain extent, where you will see some immediate improvements and synergies and ability to generate some growth organically in the same business within the same practice. But the 2 to 5 year story is we're fundamentally changing the way these clinics make money, right? That's what it comes down to. And so I think to explain that, we kind of fall back to this whole reimbursement shift in the US, right? So if you're a healthcare doctor in the US, if you're a family physician in the US, you have typically been operating independently. You're typically operating under what we call a fee-for-service model. So you have a relationship with all the different health plans. So it could be a United health plan or a Humana health plan or an Aetna health plan. There's a ton of different health plans out there. And when a patient comes in to see you and this patient is subscribed to a health plan with one of these insurance companies, according to that relationship, you're going to get paid, usually on a per encounter basis. So if that visit allows you to bill $100, you'll get paid $100 for that visit. If that visit is $80, you get $80 for that visit. So in order for me to make revenue, I got to see X number of patients a day in order to meet my minimum volume threshold. The way to make more money is to see more patients. Now, what's happening is the shift in the way the family physician is being seen as a responsible person in the overall healthcare cost of the US is dramatic. So you're starting to see now governments and insurance companies going, hey, wait a minute, if, let's call it, the annual health expenditure of a senior over 65 today is $12,000, right, a year. One senior, $12,000 a year. We're spending so much money on hospital bills and emergency room visits and prescriptions for this one senior that this cost is continuing to increase. So who influences this? Who ultimately helps control these costs? Well, if you think about it, the family physician does, because if the family physician was perhaps more responsible for that patient, took more time with that patient would end up with potentially less chronic care conditions. They might end up in the hospital less, and that each visit might end up costing, you might save a $15,000 hospital bill just by having a better intervention from the family doctor. So
it's like buying a maintenance plan in advance.
Right, exactly. And so now what you're doing is you're shifting the risk of that patient dollar to the family physician, right? And so you're saying, all right, family physician, what if you were in charge now of effectively managing that cost? Well, then the result is now the physician potentially sees that full dollar that the insurance company is getting, right? So that $12,000 now gets paid to the family doctor, and the family doctor is now responsible. So rather than making money every time the patient comes in, you make a capitated fee for the whole year almost, and you're using that capitated fee to basically manage your patients, right? That's called a full risk model. And it doesn't just go from, no risk to full risk. There's a progression and a gradual change there. And so what sophisticated clinic groups are doing, what Oak Street, what Agilon, what all these clinic groups have done is that they've built the competency to be able to manage that kind of risk. And they've gone to the healthcare payers and said, look, we're a group that's capable of managing risk. Give us those risk contracts. We will take patients. And at the end of the day, we are helping the insurance companies manage their risk and cap their losses, right? So we as an organization at Skylight go, listen, we also believe in that model. We also believe that that's better for the patient long-term. So we're going to help these independent clinics build those same competencies, except we're going to buy them while they're still a fee-for-service clinic, and we're going to generate that upside post-acquisition. So what's starting to happen now is we have started to enter those contracts, starting with like the DCE contract in 2022, where now a handful of our patients, namely Medicare patients over 65, will start to see increased reimbursement for the exact same services we provided them, given that we add a few more things to the plate. And so every year, as we continue to demonstrate our competencies are increasing, we can negotiate a bigger chunk of that money from the insurance company until we kind of get what we call as the total cost of care, which we anticipate is kind of 3 to 5 years. And so the clinics we will own and acquire from now for the next 3 years will gradually progress into that model.
Increase exposure each year.
But once we're there, once those contracts exist because the competencies exist with Skylight, any clinic we acquire automatically converts into that model. It's not like you have to wait 3 years for every clinic. It's you're waiting 3 to 5 years to build a competency, and then you're automatically transferring every patient from every acquisition into that model. But over that course of that 3 to 5 years, we're not just waiting around and going, let's just wait till we get the competencies and then we'll flip the switch. We're saying, no, our goal is to get to 100,000 Medicare patient lives in the next 3 years. And we do that by acquisition. So, today we're at 12 to 15. How do you get to 100,000? You make acquisitions every year. Each acquisition is revenue generating. Each acquisition brings in positive cash flow.
That number you said, Brad, sorry to interrupt you, but
Yeah.
That's how many. So one thing, just to say, was you go into year 2, the question would be, because I know one time you had like how many patients you had, but then you reverted the information back to how many were eligible for value-based care, right? So I think as we go into year 2, maybe just to clarify to everybody, like what that change looked like, and then how many patients as you enter year 2, as it stands today, without anything else happening the rest of this year, how many are eligible, and how many would you say are already, with the clinic, like say the ones you just acquired, like how many are onboarded today, would you say?
So you're right. So on a whole, and you'll see a certain, and this is where we separated the primary care patients from our total patient base, because as you can remember, our previous legacy business had a little over 100,000 patients there. So
note though, those patients, you still have those patients, right? Like
they're still patients, but they're going to be divested primarily as part of the certification business. But Skylight's primary care business itself has more than 100,000 patients today.
What I want, what I was meaning by that part is, you still have them, but they're broken down different categories. So that patient count's still up there. It's not like you all of a sudden lost patients or you made that number up. Like it's a real number.
One? The 100,000?
Say 100 or 150,000, whatever the number was. You have that that's the actual patient count. But then all you did was focus on your, eligibility for.
Yeah. So 100,000 primary care patients, right? So that's where that number comes from.
Okay.
And then from that 100,000 patients, you've got, we call them Medicare equivalent lives. So because Medicare is kind of the big model today where most of these health plans are focused on, you'll see similar models for other types of patient demographic groups over time, but we use Medicare equivalent lives. And so of the Medicare equivalent lives today, we've got, a little under 15,000 Medicare equivalent lives, of which there are about 5,000 Medicare lives that will participate as part of next year's DCE contract. Okay. And what happens now is there are KPIs. The way we start reporting, we sort of did this in our last earnings call, is we will kind of report on a few important KPIs for us. One is total patient count, because there's two aspects to this. One is what percentage of your total patient count are Medicare equivalent lives, right? Yep. In our conservative model, we think it's 20 to 30%, right? If you look at an Oak Street today, it's more than 60%. So again, I think that there's a lot of room there to grow, but even if you look at that today, we're less than 10% today. So
a KPI today, the key ones today would be roughly 100,000 patients.
So total number of patients.
There's about 100.
Right, total number of Medicare equivalent lives, and are we growing that quarter on quarter? Because if we are making strategic and intelligent acquisitions, then every acquisition is contributing to the growth of the Medicare equivalent population that we have, that will then convert into, that will then be able to participate in full risk contracting in the coming years. Okay. So
I remember early on you said something, Brad, and I still sticks in my head, and this is one early interview you did with Jack, and you said, like, what we're doing isn't easy. Like, it's not, you know what I mean? Like, it's not the normal path, right? Like, you could have come out and just started in that space, but you're going to pay a massive premium. Like, I watched them come out today, and whether it's 3 billion, 5 billion, 10 billion, like, they come out with that number built in, you know what I mean? Because they're in that space, right? But that's their debut to the market. Like, you're sitting today just north of 100 million. Like, so when I talk about it, yes, people say, well, how come they're not like them? Well, they're not there yet, but that's the path forward, right? So as you enter year 2, you've got now your KPIs, which you did address on the last earnings call. And I think just some people needed time to digest that, some of the older shareholders, and what that looks like going forward. But now as you go into year 2, what percentage would you like to, acquire new patients? How many would you ideally like to be able to convert? And, and how do you move them forward so that, and what's that look like? So say year 1, you're building $200 a year as an example. And then you get them. Do you try to raise it to 500 or 1,000 next year? And then is it over time to 3,000, 5,000, and maybe the goal is 10,000 down the road? But over that 5-year span, like, how do you kind of see that organic number per patient spend go up?
Yeah. So I mean, if you look at the Medicare population lives that qualify next year as part of the DCE, right? So based on a combination of capitation payments that we receive as well as perceived savings that we'll win at the end of the year, you could see up to basically close to about $1,000 per patient per year, right? $700 to $1,000 per patient per year under this model, where typically these patients are anywhere from $250 to $400 per year today. So
a 2 to 300% increase of what the previous spend was.
Yeah, on that small population, right? So then what ends up happening next year is that 5,000 attributed patient count can grow to 15, 20,000 patients. And then that value per patient in the following year will grow more, because as we continue to add more capabilities and competencies, we can negotiate a higher payment the following year with the payers. Okay. So those two inflection points are important, right? So total number of qualified patients effectively, and the value per qualified contract are two inflection points, because that's what you want to get to. You want to be able to get to say, I have, 100,000 Medicare equivalent lives at $10,000 per year, which is $1 billion revenue stream at that point. Right?
I was trying to help you understand that path from, like here we're at $200 a year. I'm going to take them to 500, or like you said, from 500 to 1,000.
Yeah, I mean, it's not so prescriptive in terms of the number. It really comes down to delegation, and that's kind of why I say our goal is to get to full risk, sort of at the end of year 3. Now, if that spills into year 4, that's fine. But the progression from now till then, we'll see that increased value. But we're hoping that by year 3 to 5, we're into the same level of contracting as our larger, multi-billion-dollar peers are today.
And that's great information, Brad, because I think now people can measure it, right? And I think it's important for them to understand what they should be measuring you against. You know what I mean? And what the goal is, and the size of the prize today. Like, I looked the other day, and as an example, I think Canada was one of the lower ones, and they're at, $6 billion plus, right? You're talking a $6 billion company. So you're at, I'm going to say 100 million American, you know what I mean? So like a US, so like you're talking like a pretty sizable prize that you're chasing. And I remember you saying it's not easy. If it was easy, everybody do it. So, but that's the opportunity, right? For me, that's the opportunity. So if you move into year 2 and I see you hitting those KPIs, growing organically, adding clinics that obviously get to skip the line a little bit and get to wherever you're at in line. You may not be at the front of the line yet, but do you want to start at the back of the line? Or you want to go halfway up the line, right? Is that how, would you agree with that? Is that what you're saying?
Yeah. I mean, look, you use Kano as an example, right? And look, they're much larger, different position, cash position, all that together. And they're buying larger transactions. But, Kano recently paid up to 20 times EBITDA for an acquisition, right? And they are acquiring a type of business that under Kano sees a value immediately based on the fact that they're already at the competency of those full risk contracts, right? And we know that we still have to get there, and that does take execution, and there's always risk in every piece of execution. That's it. And but if you look at the core business,
if there's no opportunity, you're fully valued. No offense, I'll get together with you. We'll have a glass of wine or a beer, or whatever. We'll have dinner, but I'm not investing in you.
Right.
You know what I mean? Like if I wanted to invest in somebody who was already there and had marginal upside, I'd just go do that. You know what I mean? Right. But there's a reason why your market cap at 100 million. Well, I still think it's ridiculously undervalued, but it's the opportunity. That's why people are here and watching this.
I think the opportunity is enormous. Look, we're one of the largest shareholders ourselves, and it's what sort of gets us up every day, because we are literally changing how healthcare works in the U.S. in a market where people have struggled to change for so many years. So doing something exciting as an entrepreneur, as a founder, that's fundamentally changing and disrupting a market space as big as U.S. healthcare is exciting enough. But financially, economically, the opportunity to see that translate into a totally different business in a few years from now, that's really kind of what we see as the pathway forward for this business. And that's what I try and relay every time we talk to an investor, institutional or retail. It's, look, you can't see Skylight and judge us on the way we are today. You have to see Skylight. Number one, recognize that there is already a certain amount of value that has been captured in Skylight. I mean, if you take a look at the existing population base multiplied by full risk contracts, that is over 150 million in revenue compared to where we are today, US compared to Canadian. But if you consider that Skylight's going to keep growing by way of acquisition and adding more patients to get there, then you can see how that multiplies significantly more each year we continue to operate.
Yeah, as you execute. And, I'm been a big believer in that. And honestly, if you had done a terrible job with your financials or stuff like that along the way, first I would have called you and I would have given you an earful. Secondly, I would have sold. Because if I felt there was a fundamental problem with your model, if I felt that you were buying and, like you said, your organic growth was going in the reverse, I'd have serious red flags. That's just my own personal take on it. But as long as you keep buying stuff, and I say this nicely as a shareholder, as long as you spend our money wisely and it's accretive what you're buying and you're moving it forward, and then you're organically deploying your expertise and your team, that's what I want. That's a dream. That's a dream scenario for me today. And then I look for something that's undervalued, something that's underdiscovered, something that yet be there. And you guys check that box for me. Then I look at the management team and yourself and Cash and, some of the other people you've brought in. And I think you should highlight that, because as you move into year 2, what are the changes as well you've seen? Like you have a new chairman, you have a significant board from Grace to some of the people that are there. Like, no offense, but you didn't have any of that crap. Like any of that when I first met you. Like, Norton was a great chairman. I think he, for early on and stuff what you guys did, I thought I think he added a ton of value. But as you've matured and stuff, as you move into year two, what's different about the team? Like what have you onboarded? Your people, you recently brought somebody on from Oak Street. Why do you think you have now the capabilities to do better in year two than you did in year one?
Look, I pride ourselves in the fact that we're able to attract great talent, right? For whatever reason, people decide to join us at the end of the day from whatever opportunity they're in today. It's exciting to see that talent now sitting on the Skylight side, and it gets us more excited in conversations that opportunities are truly starting to map themselves out. Norton continues to remain active on the board and continues to call me out on things and keep me honest. But look, the board's mandate is, and Patrick's been very clear about this, is to ensure that management stays guided in the direction that they're heading in. Look, they've been good for us on days where we've been looking at the share price, for example, and they've been steadfast to, hey, look, we built multi-billion-dollar businesses, and it begins with foundation and it ends with foundation. So continue to build the foundation and fundamentals. But from a leadership perspective, as we enter year two, Dr. Breckus, for example, our chief medical officer, seeing what he's built from a clinical foundation standpoint. You're a healthcare company, and if you don't have a chief medical officer that is both business-minded as well as who can relate, speak, engage, build a culture with the physicians, you're in the wrong business. And we've seen a lot of healthcare roll-ups fail in the past for a number of reasons, but also primarily because they were never able to get the buy-in of the doctors that they ended up acquiring. And I think, given Dr. Breckus's background, his experience as a clinician, he's built large health systems, over 5,000 physicians. And he knows how to run clinical teams. And so what he's laid out now in terms of the roadmap for what our physicians are going to be held accountable to, how these physicians are going to be measured, having those conversations now with the payers directly and having validation from the payers that, yes, this is in line with how they see Skylight Health delivering on those competencies that we talked about. That's all hugely exciting, right? So you've got Dr. Breckus there, you've got Mohammed Batena, who's our president with significant experience in healthcare and primary care M&A, and has been so invaluable when it comes to structuring deals, integrating transactions, helping on the operational side and the strategy side. And then other leaders as well, right? And we've got a whole level of VP level leaders that we haven't always disclosed who they are, but we've got people coming from large health systems, big healthcare payers, including Greg that joined us from Oak Street. And while it's nice to say that he had Oak Street behind him, the guy's truly passionate about what he does, and he's so experienced when it comes to patient acquisition, retention, marketing, branding. It's only been a month, but I'm excited to see kind of what we're going to do together.
And I thought those were excellent pieces that you've added to the puzzle, and I have a lot of respect for Norton. What he helped to do and early on and stuff like that, and even his own company he's built. I think he was a great chairman. But as you move forward, Patrick's built companies that do billions a year in revenue. Like I think one was from 3 billion to 120 billion. It done some major turnarounds. I think it was high IQ. From $2 to north of 50. In the U.S. major board exchange. And when he came on, just my own personal take on this, like I noticed the change in communication and how strategy and stuff like that. And as you're moving to the NASDAQ, and I recall one of the lines you said to me, something along the lines of, Patrick said something like, "Hey, if you want to be a $2 billion company, act like it." You guys, so I would say he probably brought some discipline and some other pieces for you guys. And I say that nicely, because he brought a whole nother level that you don't know what you don't know. You didn't have a guy before on your team that ran a $120 billion company.
Right.
No offense to anybody there, but that's like, it's a holy shit moment. Like that's impressive. So how you landed him, I actually don't know. I don't know what you did to get him because
I don't want to ask myself that question because he's here now.
I know you're good on camera. You talk and talk, and so that too. But and good guys, and maybe it was Cash. Maybe Cash gave him his speech. But I just think those are pieces you've added that give me the confidence to stick and focus on the numbers, and focus on the business, and the business is the stock. And that's where I've been. And but so as you go forward, I see too, as you go into year two, I believe you're going to execute in year two. I believe you do. I've added during this summer and during this dip, I've added a material amount of shares. Like I think I'm catching up to you constantly. Because I do believe I am genuinely there. but I still ask the questions. I still check to make sure each time you report and stuff like that. I know you got, another quarter coming up shortly. But I see two big avenues for growth for you guys. So you talked about the inorganic, you know what I mean? And then you haven't disclosed yet your DCE, right? I know everybody keeps asking that one, like who it is and what it'd be. And I have my own, instincts of, one of the three big guys. But at what point can you do it? And, how's that relationship look and how's it been and that kind of stuff? Like, I do believe whether it's, you mentioned Humana and would you call it Athena? I always say pronounce that name.
Etna, yeah.
And United, and I still see Centene and a few of the other guys out there. As you move forward, what point do you think you might be able to disclose that? Do you see that relationship becoming bigger? Like, I know you're probably just dating right now, but do you ever see going to the prom or anything together?
Yeah, I mean, look, the DCE was part one of the two conversations that came out as a result of it. The reason it's taking longer for us to talk about who it is I think we've skipped the dating stage,
Okay.
and we've gotten much more serious. And so contractually, that has led to.
Have you met the parents?
I think we've met the parents. Yeah,
Okay.
met the parents. Yeah, and so contractually, that level of a conversation takes more time, and there's more details to work out. But like anything else, what tells me that we're progressing forward is that I see, we've gone from initial conversations. We've even gone down and had in-person meetings together, and like a 3 to 4 hour whiteboarding session, and that is now transferred into an LOI, and an LOI, which has, again, we don't announce LOIs, but an LOI which has now been translated into drafts of deal documents, right? And what that kind of agreement's going to look like, and that agreement is now passed back and forth through red lines between councils. And so these are the things that are happening in the background that we don't often talk about, that are true of everything: acquisitions, partnerships, different things that we're working on. But because we're trying to work alongside larger players and trying to have things that are set up as a foundation for the next 3 to 5 years,
Yep.
They may take a little bit of time to come before we can announce them, rather than just announcing something as frequently as we can with smaller groups. And I truly think that, yes, while we might be putting our eggs kind of in one basket with each of these kind of different conversations, they're going to be more material for what the company's going to look like 3 to 5 years. And a relationship with a payer like this is not just like, hey, you have somebody who just is a Fortune 50 company that you can just say works with Skylight Health. I can put their logo on my deck and be like, look, we're partnered. This is a relationship where we are actually already seeing, but are hopefully going to see through this arrangement, far more support, whether that's accelerating us to that full risk model even before 3 to 5 years potentially, whether it's helping us integrate and build our infrastructure using their resources or sharing resources. You get that partner who comes on board, and that's ultimately what we want to be able to get out of this relationship, because that then gives us the confidence as a Skylight. While we are still finding ourselves on this journey to value, you're working with someone that's already so experienced and both has the backing of the capital and the knowledge base to do it well.
And I think one key with that, Brad, they also have, like, I read up on some of them, like some of them have 25 million value-based care patients, right? So
yeah, I mean, they've been doing this for so long. Right.
That's right. But I would assume, in this scenario, then, like, say you get anointed the next prince, and you're their partner in those markets. I would assume they'd be saying, like, please take care of our patients. You know what I mean? Like,
they are, and it's acquisition of new patients. I mean, look, it's also acquisition pipeline. These groups struggle constantly with market share, right? You've got each of these healthcare payers fighting each other over in markets for patients and doctors and clinics. And when you have a friendly doctor who's now been acquired by another player that's friendly with another payer, you'll lose that doctor. And so these guys know of doctors that are looking to sell. They know of clinics that need to exit. And if they had a friendly acquirer who could come in and keep them in the network, they're going to want to push that clinician ideally that way. So,
the cost of acquisition on those patients is massive. So
right.
Anything they can do to protect their patient, and have them also well taken care of, like combination, right? Protect them, but then also know that they're being, managed properly, I think would be gold to any one of them. And, that's right. I've done more reading on United and Humana and seen a few of them that I could ever imagine. And that's my short list of one of those three. And that's who I believe it's going to be. And I'm still waiting for my Christmas present.
Well,
I know it's coming, Brad.
Yeah, I'm working on it. Yeah.
I know. And you know, and I see that, and because I watch, you know, something that I know people think even realize, but if you know, I posted the other day, like that Village MD deal, like they valued Village at like $15 billion.
Yeah.
They brought in a partner, Walgreens, you know, and I believe it was I forget the
chain. Yeah.
The chain, but they partnered with them, injected like, you know, I think the other day it was $5.2 billion into the equity for, I think it was another, I don't know, 30% of the company or something, 32% or something like that. And, you know, I look at you guys obviously growing it, executing it, and I'm, you know, I have to believe you're a natural for somebody to, I'm going to say, lock you down early. You know what I mean? Like the smart guys, you know, and the smart guys in high school tried to, you know, get the pretty girl early. You know what I mean? And lock them up.
I mean, look, Sean, to say that we haven't already had conversations with large groups out there today that have said, hey, look, Skylight's on our radar. Skylight would be a type of practice we'd acquire.
Yeah.
This is a market share game, right? Everyone is trying to accumulate a market share of Medicare patients. And I know that doesn't sound right when you're in healthcare, but you know, at the end of the day, patients do benefit from this. But you know, when you think about it from that perspective, as you continue to acquire and get to scale, and you have the competencies, your attractiveness level continues to grow. And people know, because I do come across some of these peers in markets on some acquisitions, and I have, you know, potentially taken a few deals away from some of these larger players because these smaller practices want to be acquired by, you know, a group that's more personal, not such a large entity. And so, you know, I don't think it's a question of if, can we, etc. I truly believe that we are so undervalued where we are today, and the potential for who we can be in 3 to 5 years from now, unless it's something sizable and totally unrealistic, I would expect that Skylight Health is going to see this plan through, and then at that point look at something that potentially might make sense for the business, but is going to make complete sense for our business and our shareholders and everybody involved. Yeah,
I get that, Brad. And because you know, even the big guys, they still have leakage, right? Like they're still going to lose some customers. So they got to still keep going and buying more, because other guys are going to keep picking off some of their, you know, their patients, stuff along the line. Some of their patients pass away or whatever. You know what I mean? But you have leakage all through the business, so they got to keep acquiring more too. So I see. I mean, it'd be smart for somebody to either partner with you guys or buy you guys at some point.
I mean, look, we have immense conviction, right? I mean, look, like anything else, we'll see some trips and falls along the way, and you know, that's always been the case when you're starting a business. It started when we first started, you know, the business here, and then to where we are today. There's things you learn along the way, and there's things that sometimes don't always work out the way you need them to. But we have such immense conviction that the business model itself is both proven, but that we have a capability to move there, that we're going to want to see this thing through.
Exactly. And I think that, you know, so that's part of my, you know, organic growth. And I think you know, how you do it that way. But then when you look at the other side of it, I understand there's buying stuff, but there's other plays that other guys have done in the market. And I kind of related it to you guys. And I looked at the path that Shoppers Drug Mart went, right? You know what I mean? Like they partnered up with Loblaws and they went that way. So they went in a bigger footprint, you know, almost a real estate play, but to capture audience, capture customers. You know, Shoppers ended up getting acquired for a massive amount of money from Loblaws. It was very strategic. And, you know, I related that to the US, and I went to some of the biggest ones that are down there, and I looked at Kroger and I looked at Albertsons, and they're monsters, right? You know what I mean? From some of the brands, and there's Publix, and there's a few of them, but Albertsons owns brands all over the place. And, you know, your Kroger side are massive as well. And these guys have like huge audiences, you know what I mean? Like in real estate plays. And I could see as well for you guys being like the Shoppers up to a Loblaws or something like that at some point, right? Where you could look at not only real estate play, but a patient play for real growth if you were partnered with one of the big boys in the US like that.
Yeah, look, that's what Village MD did, right? Village MD has a model that's very similar to Skylight. Skylight is a model that's similar to Village MD. They're massive, but but yeah, funny enough, we're not in the same market. So I mean, that's how big this market is. But what they did with Walgreens is, to your point, similar, right? You attach yourself to a brand that has significant exposure, where you can see yourself, you know, we use the fancy terminology de novo. I never used it before I started working in the US market, but organically opening up clinics. And so, you know, you can set up these organic sites without having to invest significantly in real estate. But it is organic, so anything organic will take a little bit more time than buying an established practice, but your cost of patient acquisition is significantly lowered, and it's a complement. Yeah, and so it's a complement. So, to kind of read between the lines here, to say that we're not working on an agreement that can offer us potential scale through organic sites would be wrong. We are, and there are conversations that we have, again, things that are happening in the background.
Great, but could you deliver that organic?
Yeah, I do think so. I really do think so. I think complementary in parallel to the acquisitions will be a strong growth by way of organic story that allows us to build faster in existing markets, add more scale, use our brand potentially in these markets to capture market share away from competitors without having to acquire them, and really kind of bolster our patient count. Because again, remember, at the end of the day, we're counting two metrics: total number of patients against the value of the contract.
You're no different than the big guys that are trying to capture more patients, Brad. You know what I mean?
No.
You're in the same game. You're on the ground. You know what I mean? They're trying to operate it on the payer level. So that was my question: was did you see that as an opportunity?
Absolutely.
You know what I mean? Because I see some of them out there, and I literally look at Albertsons and Kroger and the thousands of stores these guys have, and I'm like, wow, there's a path for Brad. You know what I mean? If he was to, that way, but can you go and grow organically versus just buying? Like I said, I know it's a slower growth, and I used to have this argument with the CEO, not argument, like fun, playful, but I'd be like, see, you can grow organically. Like if you have a good team and you have good people, you can actually grow organically. And he'd always finish the sentence with, and buy more. Because and I was always like saying, yeah, but I think we can grow this thing organically sometimes just as fast as you can spend cash and replenish the kitty so you can go buy more. But some people don't have that discipline. They don't have that talent within the four walls to be able to do both. And if you guys can do both, as well as, in my opinion, get connected, get the nod to be a partner from one of the big 3 or 4 out there. I pound the table all the time. And, it's lonely sometimes. There's one other person that bangs with me a lot, but there's you guys have the real pathway to $1 billion. And I don't say it quite the same way Jack does. But I try to put it in context today, and people have a hard time comprehending it. But when you were at $1.90 at your peak, that's equivalent to about a $9.50 price point. Today you're at $3.50, and people have no clue. Is it expensive? Is it cheap? Is it whatever? I'm like, are you kidding me? This is ridiculous. Like $1.90, I was laughing. People did you sell any shares at $1.90? No. Are you crazy? I go do you understand what he's after? To put it into equivalent, when you do the math, to get you to $1 billion, you're close to a $30 per share price. Close to it.
Right.
To get to $1 billion market cap, you're taking to $30. And like you said, I think that's a possibility. You're talking about $1 billion in revenue over time.
I am.
Not $1 billion market cap. Well,
No.
$1 billion, these things, what would you say the average one trades for today?
I mean, most of our peers are trading at 7 to 10 times, or even a little bit north of that.
On revenue, right?
So on revenue.
Yeah. So if you look at that, if you get this into $1 billion, let's say if you get to 500 million as an example, and it traded at 7 times, you're still $3.5 billion.
Right.
Today you're at 100 million-ish. I don't know where the heck you get that. But with a business though that's demonstrated you're executing, you're growing it. You told me you went from 13 million to 41 million year over year.
And that's just calendar, not run rate. But yeah.
That's not run rate, just real numbers, calendar over calendar. And you're moving in next year, which I'm assuming is going to be an up year again. You're not anticipating a down year in 2022?
No, I mean, not with our pipeline. No.
Exactly. So I literally bang the desk and I say, okay, I watch Village MD do a deal and get $5 billion injected to them. I see that, as soon as you got the DCE, I'm like, oh my God, there's something coming behind that, because you don't just get that, because there's obviously something bigger. And then secondly, there's obviously the organic growth opportunity. And as long as Brad's executing the business, like I said, I'm sorry, but I just have a problem. I just buy more. You know what I mean? I buy more shares. And when it was down to $253, I was like $350, buy more. You know what I mean? I think the broker thought I was crazy, but I really see the opportunity. But I checked that off, Brad, by not just because I like you guys and your team and what you've built since you were private till today. And I still remember, the funny part is you were 10 cents, 7 cents at one point. The equivalent today, you're 80 cents. You know what I mean? It's still 8 times where it was, and it's low. You built a business from when I met you. I think you were targeting 2 million in revenue. Now you're at 41. And some people probably wish sometimes I'd be really mad at you. You know what I mean? But I have a bit of a comprehension of what it takes to build a business that's going to last long. It's not a pump and dump. It's a real thing. And to go from 2 million to 13 million to 41 million, I still compliment you on that. Like, don't get me wrong. I wish the stock was
Thanks.
$10. Like Jack gave you a hard time earlier. Said, "Well, your stock should be $10."
I told him the same. I wish so too, right?
Yeah, but you know, I mean, but if you weren't operating the business well, then I'd be pissed. You know, I mean, I'd just sell my shares and I'd be disappointed. You know what I mean? I'd move on because it'd be a missed opportunity for everybody, your family, the company, the shareholders, the team. But would you say that as you go into 2022, nothing's changed other than you're better positioned, you're healthier as a business, and you probably, you know, you learned a little bit too, because, you know, I mean, the walk out of the NASDAQ, you know, I mean, we all got our asses kicked. You know what I mean?
Yeah, I mean, look, that is true to a very, very big extent, and you know, overall, I think the euphoria in the healthcare space has seen a little bit of correction there too. But I don't want to look externally and, you know, benefit from any excuse. But you know, what can we do to impact that change back again? Yeah, look, I think we still exit 2021 with a number of important catalysts. I don't think we're done yet. Like, we're not.
So you're
we're
not
not
done for the year.
No, we're not done for the year. I think I still feel strongly that the things we're working on, some of them will certainly come to fruition by the end of this year. Now, do our best to keep moving them forward, but I do feel like that is true. So I don't think we're done this year. I think we're talking now, and we're going to see more catalysts before the end of this year. And then, yes, in 2022, we're definitely going to see more catalysts as we continue to keep executing. So I think we talked today from, you know, next year compared to today. I think the business looks a lot more different than it did the year before that, and same thing with the year before that. That's all we can do. That's what I can control, is ensure that I can keep adding more value to the business, and then that business continue to tell the story, continue to keep our constituents engaged as to what's happening, keep working to build more institutional research coverage, you know, and that's it.
And like, that's the last piece I want to touch on is, like, I don't think even for the most part is the average Canadian shareholder has a clue what value-based care is or what that means or what the value of that is. Even your competitive set, most of them wouldn't even know the tickers of the competitor set. They wouldn't know.
Right.
And, you know, I would say this is probably the same true for a lot of the analysts though. You know, like, you have one analyst a while ago, mentioned, like, you know, comes out and says, well, going slower, I'm going to, you know, lower it. But then a U.S. analyst comes out that people actually know and respect in the healthcare space. What was happening? What was his take on it when you met with them? Like, they gave you feedback. What was their, in 1 minute? What would you say? What did they say? What was the price they came out at? They believe that, you know, in the next 12 months your business should be worth X.
Well, I mean, look, to them, they're looking at our business as heavily undervalued, right? I mean, I think they came out with an $8 and $9 USD price target, right? And these are analysts. You're right. There's a fair amount of education that goes into a Canadian market. Our healthcare system is different, right? And there's not a lot of stories that play in the U.S. healthcare space, but there are a lot of U.S. stories that play in that space. And these guys do cover and do look at those stories as well. So I think they know the potential of that market. They understand that potential. And then the question is really, what is Skylight doing to become a major player in that space? And the validation, we're not approaching these analysts with, look, we hope to acquire clinics, we hope to be able to drive patient growth. We're coming to them after 12 months of executed success. We're saying that this success should be repeated year on year. And we're now showing them that we have the capabilities to negotiate contracts with payers and be at the table of contracts with payers. So what they understand to be true already in the industry is starting to now be validated on the Skylight side. And we have great conversations talking about the market and competitors in general, but there's a lot of excitement for the way that, especially when you think about from an investor standpoint, where we're valued at today, to your point, what this business looks like 3 to 5 years from now.
Yeah, and just the last point for me is they say, like, I've heard this a few times, like the level of due diligence the healthcare analysts do in the U.S. versus some of them in Canada, especially for a business.
We actually had one of the U.S. analysts fly out to Colorado and do a site tour of our physical practices before they initiated, and so he actually had pictures of our clinics in his initiation report, which I thought was really cool.
That's not typical. You know what I mean? That's not typical of the regular, retail analyst. Like, I don't believe so at all. So I tend to put a little more credibility in what some guys are saying that have been boots on the ground, done there before, look at their track record. So, I'll let Jack come back on and say his piece. But Brad, I just want to say thanks for doing it today. Like, for me, it was hopefully, the people that are out there, both new and old, get to see, a little bit about who you are, like who you were, who you are today, and who you want to be when you grow up. And
I appreciate it, Sean.
Thanks for bringing the jacket back. It's been a while. It was time. Because your team has a lot to be proud of. Don't get me wrong. I'm like, Jack, I wish your share price was $10-15, but I can't be mad. It's like my kid. If he tries really hard, he does a good job. I'm proud of him. You know what I mean? So I say
appreciate that, Sean.
I say that to you, that I'm proud of the business you've built. Just, over time, let's fix it together. Let's fix the stock price.
Agreed. And I appreciate it. Thanks, Sean.
Jack, I'll let you chat. There's the best one ever when Jack's mic's off.
You hear me now?
Now we can hear you, Jack.
Okay, fantastic. Okay, Prad, thank you for coming back. Sean, always a pleasure to have you on with these interviews.
No problem.
We always have a spot here available for you for full time when you're ready to, put on the suit and tie, get a real job,
Thank
Okay,
you,
guys. Thank you again.
Thank you.
All right.
Bye-bye.
Okay. All right. Let's get ready for our next exciting presenter, Organic Garage. Let me just get things set up on the screen here. Okay. And we have Matt. Matt, can you hear me?
Hey, Jack, how you doing?
All right. Fantastic. Okay. We got one more. Hang on.
Yeah.
We got Afram. Can you hear me? Afram?
How are you? I can perfectly.
Okay. The mic just kicked in.
Can you hear me? Okay.
There's a little bit of a delay. I think on your end.
I'm here.
Do you want to maybe log out, come back in, or okay?
Maybe I'll get off Wi-Fi and I'll go to data.
Yeah, okay. Yeah, the internet, it's a little slow on your end. Okay. Let's see. Okay, we got. Is everybody using
that
their
better
cell phone or something today? we got the vertical screen. Okay, we'll have to keep it like this. No, I think this is good. Okay, let me. Can you just say?
Can you hear me and see me? Okay. Yeah. Okay.
Okay. Now it's a slight delay, but we'll be good. We'll be good. Okay. Hang on.
I can. Okay.
Let me just make sure everything is set up here. And okay, let me do a quick intro, and we'll get started here. Okay. All right. Welcome everybody to Wall Street Reporter's next Super Stock live stream for November 2nd. We are back with Organic Garage, OGGFF, over-the-counter OG on the TSX.V. And for those of you who might be new to our program, our goal is to bring you those stocks which have that 10x to 100x upside potential. So these are companies going after massive multi-billion-dollar market opportunities that are at a key inflection point in their growth, and there are multiple catalysts in place to ignite that shareholder value. And today we are going to be speaking about plant-based foods, consumer packaged goods, all that good stuff with Organic Garage. Because I think, again, we're talking about catalysts. This is, I believe, one of the big catalysts for, I think, for creating a massive amount of value. I mean, the stock right now is trading at a $25 million valuation. And your business, I mean, the stores, the 4 stores are, you're trading at basically one-time sales right now. And, you just announced more store rollouts. And so essentially somebody's getting the plant-based business for free when they're buying the stock. And we've seen these plant-based stocks. I know on the Canadian side, they're trading at crazy multiples. We have, Oatly. We have, Beyond Meat. Tattooed Chef. I mean, there's a list of about 100 of these guys right now. So it's an exciting space.
Yeah, Jack, I happy to be here and have one of the co-founders, Afram Pristine, on as well. But you're absolutely right. I mean, we talked in our previous interviews. Look, we're doing a lot of exciting things on the Organic Garage, organic grocery chain side with our store rollouts and our expansion potential. And we've clearly outlined that. But I think, today's episode is great to talk about, the plant-based opportunity through the acquisition we made earlier this year, which was Future of Cheese, and what the potential is for that from an investor side, and why they should be super excited and enthused about the direction that's going in, and what that could lead to kind of share price appreciation, given kind of what's going on in the plant-based space, which is it's just explosive, and it's something we recognize as a publicly traded company that, was there an opportunity for us to access that space? And this opportunity came along, and it was too good of an opportunity to pass up. And that's something that we can definitely speak, about today.
Okay. So Afram, you're the co-founder of Future of Cheese.
Yeah, one of them. Yes, sir.
Okay. And the other one at some point is going to join us. Today, it's only you.
Yeah, that's me. Yeah, I think I'm enough for today.
Okay, fantastic. So, the first question I have is give us kind of the background, so the plant-based, your background really is in the cheese. We'll talk about that. But
Yeah.
I think the main idea for investors is, okay, they want to know is, okay, what are you guys doing? Look, why did you, plant, obviously there's a lot of investor interest in plant-based foods, different ingredients, whether, you got the meats, whether it's Beyond Meat, you got Oatly, you have different categories. I think there's even fish, vegan type fish. Why plant-based cheese? What do you see as the opportunity here?
Yeah. So, well, I think, Jack, I mean, to talk about my history and background, I think makes sense to answer your question. So, I'm born and raised in Toronto, from immigrants like many Canadians and Americans, of course. And, my parents and family came here because Canada was, one of the lands of opportunity. And cheese put food on my table. And my parents in 1970 opened up something called the Cheese Boutique in kind of the west end of Toronto on a $500 loan from the Bank of Canada. We're 51 years young now. We're 12,000 square feet. We have a couple different stores, a huge distribution channel, wholesale, retail. It's a big shop. 2020 was our best year ever. 2021, we're going to surpass that as well. What I know is cheese, Jack, and there's not many things in the world I know other than cheese. We sell, over 500 different cheeses from all over the world. My training, me personally, this is my 25th full-time year. I know I'm 41 and I started very, very young. I learned from the best cheesemakers and chefs on the planet. I have a national best-selling cookbook. Sold a lot of copies in the States as well. And the first ever documentary in Food Network history called Cheese: A Love Story. It just aired this summer in Canada, and Amazon Prime just picked it up as well. This opportunity came to me, and Matt came to me, and, I was extremely intrigued because the cheese world, Jack, is enormous, okay? There's many different cheese styles. There's many different cheese families. There's cow milk, sheep's milk, goat milk, semi-firm, aged, blue. It goes on and on, okay? Now, plant-based cheese is one of those categories. Is it in the mainstream today? Maybe not. But tomorrow, 1 year, 2 years, it will be considered one of those families that I just told you. And I know this as, Toronto is one of the biggest cities in North America. We move, I say it humbly, we move a lot of cheese on the retail side, on the distribution side, wholesale side. My job is to understand what sells. My job is to understand what's going to be the next movement in cheese. This is it, Jack. This is honestly it. And when Matt came to me, I took my 25 years of cheese making experience. I took my 25 years of cheese aging and cheese ripening experience into the plant-based world. I love a challenge. And, that's how my family business was started, by risk. And honestly, 51 years into this, I love the potential of this, and I put my heart into it, and I put my knowledge into it in a way that I honestly, humbly feel hasn't been done yet. And I think we have an amazing product, and I'm really, really proud of it. And, we're young and we're hungry and we're experienced. And I think the sky's the limit. And so far, so good.
Okay. So, Ephraim, you also have, it's not just cheese. You're also doing butter. There's a whole kind of, Matt, like basically it's, would you say dairy alternative? Okay, there we go. We got the, bring it up to the camera because a lot of people out. Okay, so
that's the baby. That's the baby that was just announced.
Let's give us the 3D. Turn it over. Let's see the whole package. Okay.
So this all is like organic, all certified organic, Jack, non-GMO. We're using all natural ingredients here. There's no fillers. There's no bindings. Like this is, I'm old school trained. I'm old world trained. I brought that technique and that tradition with local ingredients as much as possible. Okay. And honestly, we're making world-class products. That's the butter. Okay. I even have some more to show you. That's the butter. Beautiful. It's
So that
doing
was
really
just
well.
unsalted.
Yes.
Okay.
That's the
Yeah, so
salted,
Jack,
but we
when
have
you talk
salted and
about-
unsalted. Sorry. Yeah.
Okay.
So Jack, when you talk about the opportunity with the brand, you know, we start with butter. Butter is a staple for, you know, for anybody, and not only for, you know, a home user, but an industrial user, for anybody who's baking
Okay.
cookies or things like that. So they're using butter in a variety of ways. And in a food service side, so Afram knows as well as anybody, because he services hotels and large food service operators, butter is a staple. So when we talk about butter, the plant-based butter market was a $2 billion market in 2020. So when
Okay.
you're talking about what's happening in plant-based, and I'm talking about just butter, forget about the cheese and all the other things that the future of cheese and Afram and his team are working on. The butter, plant-based butter business alone is a $2 billion market. And so when you start to talk about the opportunity that exists, and what we saw, you know, with this acquisition was accessing not only a space on the investor side that is just absolutely on fire with the capital inflows and everything that's coming into the market, but you're talking about a category in the food business that is growing exponentially. Okay, this is not a fad. This is not a trend. This is only going to increase over time. There's lots of factors that are contributing to it, everything from environmental factors, political factors that are contributing to the growth of plant-based, dietary factors, dietary changes, things that accelerated with COVID, with people focused on their health. It is an exploding industry. And I can't stress to, you know, investors and people that are watching this, we are on the ground floor. So as a retailer, and Afram knows from his own retail business, we are seeing the trends and the changes going on firsthand, because plant-based companies come to companies like Organic Garage and, you know, small, specialty stores like the Cheese Boutique first, before they're going to mass chains. So we're seeing things before they even hit the market in the broad stream, mainstream market. So the potential here is just astronomical.
Okay. Yeah, and I kind of want to get into that a little bit later in the interview, like talking about, like, you know, because you have a very unique kind of perspective in terms of, you know, there's a lot of plant-based brands, but you have a unique perspective because, you know, you're in the retailing space. You have, you know, you're selling, you know, $25-30 million worth of organic plant-based products through 4 stores. So you understand what moves on the shelf. So we'll talk about that. But, you know, one thing which I actually didn't realize till now is, so you're going to have different SKUs, but like I didn't even realize that butter is actually a staple. It's kind of like salt, you know, it's used in a lot of different, you know, it's used in almost everything. Anything to taste good, it needs butter, really.
Well, when you're talking the dairy category,
Well,
it's milk, butter,
look,
eggs.
Jack,
those are the staples.
And Jack, honestly, butter is, you know, very heavy French, cuisine, right? A lot of butter, a lot of cream. I mean, this is, and I don't know if you can tell by the color, Jack, this is the best butter in the world, okay? And you can Google this. I happened to train for 6 months of my life making camembert brie and butter in Normandy. That's what they do well, is full fat cream, full fat butter, full fat, grass-fed, like all that good stuff in butter. I took all of that training I had and used plant-based ingredients, the best ingredients I can come up with, to make that exact style of butter, where it's cultured, it's flavorful. This, leaving it out at room temperature on butter, is better than sliced bread. I mean, this is honestly, I'm very proud of this product. And I think Matt kind of said it. I mean, everyone has a stick of butter in their fridge. And I think Matt and I are very unique and we get along very well. Jack, I'm wearing my apron right now. I am on the floor. I'm hearing what my customers want. I've been doing that for 25 years. I listen. We are there. This isn't trendy, okay? And that's what kind of bothers me when people kind of talk about, this is not trendy. This is quality product that people want. People come to me and ask me, Afram, I want a plant-based butter. I want a plant-based brie. I want a plant-based cream cheese. I'm going to go get them the best product possible. That's really my motivation here. Okay, of course, you know, if we can make some money, that's wonderful. But that is my motivation here. My job is to get people the best product possible. I am a supplier of happiness. That's what I'm doing. This isn't a product for only plant-based diets. This is a product for people who want to eat well. And I'm proud of this. I want to show you the brie, okay? Matt gave me the go ahead and I can show you the brie because I'll tell you, Jack, of everything I've ever done, okay? You know, I'd love for you to do some research. I'm proud of what my family and we've accomplished. And we came from nothing, and I think we've done something really, really special in Toronto and Canada and abroad, okay? This brie, Jack, here.
Is this the next
is
product?
my This is coming out soon. This is coming out soon, okay?
Can you flip it over? Let's see the top. Let's see the top.
Yeah.
Okay.
This is
you have herbs on
one of the no. That's mold. That is what I call controlled mold. Jack, making cheese, aging it is equally important. This is one of the first ever surface ripened bries. This is my Sistine Chapel right here, Jack. This is what I've worked my whole career. I didn't know it at the time to get to. And I'm so proud of this. This is all my training in France, in the region of Brie, in Normandy, making cheese. That beautiful, you're looking at it, it's kind of that kind of grayish, like white mold. That is perfection. When I look at this as a cheese expert, but as a cheese lover, more importantly, this is what I want to see. This is a visual sign. I know the cheese has been properly matured. Jack, I'm not kidding when I say this because I know this business. Nobody is doing this right now. And I'm proud of this. I'm going to cut it open for you. Okay.
There we go.
It's beautiful.
I mean, it looks like the real deal. I mean, like, you know.
That's it. Yes. Yeah. Yes. We don't want this to be like, this is not like faux cheese or, you know, fake cheese. That bothers me when people say, oh my God, it smells so good. Sorry. But that's what bothers me. This is going to be, maybe not now, okay? It's still early. The whole plant-based like food movement, not just dairy, is still fairly new. This is going to be one of those cheese families I mentioned to you at the beginning of this interview. That's the case because people want that product. So what am I going to do? Go get them the best product possible. That's the brie. I love it. It's very, very, like I said, this is my Sistine Chapel right here, and I'm proud of it. Ripened for 30 days in a proper environment, climate controlled, humidity controlled, exactly how brie and camembert in France or all over the world is ripened. This is what we're doing with this product.
Okay, so that's so a couple of interesting points. You said something, Afram, which is interesting. You said that that plant-based is going to be its own category, kind of like, you know, like every couple of years there's a different cheat thing that becomes. I know you hate the word trendy, but yeah, something becomes like the next thing, right? So in other words, you're saying that plant-based is just going to be be one of the categories, like brie or like, I don't know, what is it, Manchenko, you know, the Spanish, the whatever it is, you know, it's going to be one of those things.
Like blue, manchego. So, right, there's blue cheese. There's the blue cheese family. There's goat cheese. There's sheep's milk cheese. There's cow cheese. There's creamy cheese. There's firm aged cheeses. There's lactose-free cheese, which was a big thing maybe 5 years ago and took off, and that became its own. This is not next. It's really happening now. Plant-based, this will be one of those categories. I am supplying, I mean, some of the best. So beyond just a retailer, we're like a kind of an anomaly of a shop because there's a lot of little moving parts. I wear a lot of hats, Jack. And, you know, I was with, you know, a very famous chef, Daniel Boulud. I think you're from New York. Daniel Boulud, one of the greatest chefs to ever pick up a knife. I did a catering event with him because he's got a couple restaurants here in Toronto. It was a big, big dinner. And, you know, he's like a mentor to me. And you can ask him yourself about this. He tried my butter and said, Afram, I don't know how I'm going to use it in the restaurant, but I want to use it in the restaurant. This is literally one of the greatest chefs to ever pick up a knife, a mentor of mine. It was one of the biggest compliments I've ever had in my life. this is what I want to do, Jack. And working with Matt, he's the business side of it, and I'm, the more technical, like creating. This is our cream cheese coming up soon.
Yeah.
Our beautiful,
Wait,
creamy, full fat, plant-based, all organic, all natural.
Okay, so Afram, I want to ask you. About okay, so a couple things. So there's a butter. I've had the French butter. It's like I forget what's it called. I think it's from Normandy, and it's expensive.
That's the one
it's like
I make.
$7 in the U.S. or something. It's like
Saint-Mère.
Yeah, that's the one. Okay,
Jack. That's where I trained for 3 months making butter. That's exactly the one. So you have good taste. I like.
So yours tastes the same? Is it? Because I don't have. How does yours compare?
Look, for quality, it's a slightly different product, right? Like we're talking a cow's milk product. We're talking plant-based ingredients. In terms of quality, technique, and tradition, it's made the exact same way. Literally, I made that butter in Normandy when I was 23 years old. I'm taking all I know there and making it with all organic plant-based ingredients. But that is a perfect example. And that butter, you're right, in Toronto and in Canada, it sells for $25 for a half pound. And I sell it all day long. This is a little less expensive, which is good for us. So we can move a lot more of it.
Yeah. So this is what I want to ask you. So what, so how much does that package of, I don't know, how much does that sell for?
It's 250 grams, depending on the retailer, right? Like we're in premium shops right now. I mean, my shop, Matt's shop, many other shops. I want to say between $9 and $11 for a half pound. Okay,
Canadian.
So Canadian.
$7.
So
half a pound is a lot. Half a pound is a big piece. No,
it's a big brick. Oh yeah, yeah.
There's traditionally there's traditionally a half pound or a pound. And the range often gives that flexibility depending on the retailer. We're a value retailer, so we'll be on the lower end. A specialty retailer who can achieve some higher margin, they're going to be on the higher end. But it gives that flexibility.
Yeah, and Jack, to kind of give it into perspective, so that Normandy butter we're talking about, that is, the cream of the crop. Okay, it's very hard to get, small production. It's the best. This product, apart from that, just take that butter away. This product in Canada, we have amazing full fat, grass-fed butter, all that beautiful stuff. This is on par in terms of definitely quality, but pricing as well. This is a premium product, but people pay for quality. And look, we're selling $10 loaves of bread that we can't keep in stock. People are paying for quality. They want. And this is a big thing, I think, for my customers, is trust. We're doing this 51 years. People trust my brand. People trust me when I say, hey, this is a good product. I'm endorsing stuff I'm proud of. I'm endorsing stuff that is the best in the world. I sell the best in the world products. And I'm confident in saying that too, because that's the case. I wish you can come and we can go for a tour, but that's okay. Next time.
Okay. So basically, the bottom line is, so it's essentially that, in other words, this is basically your butter, the future of cheese butter, is like on par with that EC. Is it EC, right? I think it's EC or something.
EC Saint-Mère. It's the town in Normandy.
Okay, so it's the same. So it's on par, which is that was amazing stuff. And so quality wise, price wise, you're a little bit less. So it's a big.
Yes.
It's a big. It's interesting actually when you think about it. In theory, if the best butter is comes from the grass-fed cows, and this is a plant, kind of makes sense. Plant-based could be good butter. It's from the grass or whatever.
Yes, but this is exactly it. Do you know? But I'm happy you said this. In Normandy, okay, for example, in Normandy, the cows, to produce that butter, okay, to produce the milk to make that butter, only graze from May to October. From May to October, the French have a term they call grand foin. It's the golden goose. It's tall grass. Over the summer, the cows graze. The more flowers and blossoms grow from the top of the grass. But Jack, this is what we're using. These are the ingredients that we're using already naturally to make this product. You can see the color. There's no dye in this. Look how golden, like it's golden yellow with even a tinge of orange. Like this is no natural, no dye, or it's natural. There's no dyes or nothing. This is the Normandy Isigny version of plant-based butter.
Okay, so basically,
I'm proud
from
to
what I
say
understand, essentially is you're coming to the line, the future of cheese line, really from that kind of like artisanal background. So this is like, you're not coming from like craft foods where it's like mass kind of, they come up with some mass. You're really coming from like really a very, very high end angle, and at a reasonable price. I mean, it's sort of like, it's not going to be any crazy price, which I think in the case of butter, I think somebody just made a comment, is somebody said it's, I don't know, they said it's expensive. I don't know, $11, is that Canadian or whatever? But I think in terms of the butter, because it's really, I don't think it makes a difference, because like you're not using the whole thing of butter when you're cooking. You use just a little bit, and it makes a huge difference.
No.
That East butter, I remember using that butter, like with like a salmon. It makes a huge difference.
Yeah,
like massive difference.
I also want to qualify, because we carry numerous plant-based butters, that the future of cheese butter is right in line with the butter, the plant-based butter category. So if people are comparing, plant-based to non-plant-based, or a discount butter, or you're talking about completely different things. I know what I sell organic grass-fed butter for in my store, so does Afram. I know what I sell other plant-based butters for in my store, so does Afram. So the future of cheese, future of butter, and all the lines of products that we're carrying are meant to fall right in line with where the category is. This is not on the highest end of the category. This is not a discount banner brand that's on the lowest end of it. This is meant to be top quality product, right in line with where the industry is trending. And for those that follow the industry, know that range of pricing is well within line with the other competing products within the category.
Okay, so I think one of the things that I want to kind of come back to, one of the things that I kind of see as unique in terms of when you're launching, when Organic Garage, launches, these branded products, your own branded products, is that you actually understand, not from a theoretical place of like, hey, what sells, as like, certain, brands, but because you actually have the retail experience, like you understand what sells, what it needs, like what the real full perspective, like the whole forest, not just the trees, but the whole landscape, which I think is very, very, it's a good thing. So I want to ask you, how many different products? So right now you have the cheese, the butter, cream cheese, brie. How many different SKUs are you going to have?
So beyond those three, there are two more, like done, in my opinion, perfected and ready to go in the next few months. And these are products, one in particular, I'm as equally proud as the brie, because this is something that has not been on the market yet. And I'm talking like on a easily North American scale, but even in Europe, in the plant-based dairy world, I have one product that I'm going to keep under my hat today, at least, is extremely special. And this is something that people are going to want to have in their fridge at all times. It's one of those products. That's a couple of months away.
Okay.
So around 6. So excuse me, Jack. Pardon me. I talk a lot. I can't help it. I get excited. But around 6 products you'll see within the very kind of near future, for sure.
Okay. So so one thing which is interesting in terms of the size of the market opportunity for plant-based dairy alternatives, I'll call it. So I never really thought this was a big market, but apparently, like, you look at stocks like Oatly, right? Oatly now is, this thing is it's a couple billion market cap. I think the thing, massive. The stock has gone absolutely crazy. So I think they're saying that the market for dairy dairy, like milk is $600 billion world. So I don't know, what's the size of, like, for what you're doing, how big can you scale this? Like, you know, with these 6 products, I'm sure you're going to add more to the line, but how big do you see? Because this is not just going to be in Canada. It's not just going to be in Toronto. This is, you're going to basically, the idea here is to take Future Cheese, all these, all your products, and go, I don't know, international, but definitely for sure North America, US.
Yeah, Jack. Yeah. So to put it in perspective, I mean, like I said, the plant-based butter category alone is 2 billion. When you look at plant-based overall as a category in the next probably 5 or 6 years, it's estimated to hit almost 75 billion in US dollars in terms of the market potential. So you guys have seen firsthand companies that have gone public. You mentioned Oatly. Everybody knows the Beyond Meat story. There's lots of companies that have gone public, you know, here on the CSE and the TSX.V and here in Canada, in varying categories, everything from plant-based dairy to plant-based meat. The category is absolutely on fire. So when you talk about not only consumer potential in terms of physical dollar sales, it gives you a small taste. When we talk about the stock market potential and kind of the focus that's going on and the capital inflows that are going on, it is you know, just the category is on fire. And so the potential is there. You know, it's something that we saw firsthand. We've seen the market evolve over the 15 years we've been in business. And I hope investors on this call have seen a small taste of the passion that Afram has. And when I talk about a differential, you know, when people compare brands to one another, one of the key differentiators in our brand is our co-founders, Afram and Craig. Like, you cannot get better, more knowledgeable people about an industry than the 2 co-founders, one of them that's on here today. And I can't put a price on that. You know, Afram touched on it, and we don't want to diminish. You know, Afram spent time, you know, with the Food Network. He traveled the world being with cheese producers. Like, you can't get somebody who's more knowledgeable and understanding what's happening in the cheese industry. Look, I know what's going on in plant-based from my own experience. And this is where I said originally on our previous calls, Jack, you know, I bring a level of expertise in terms of what's happening with the plant-based market, you know, how to position the company from a grocery store perspective to launch products, what needs to be on shelf. Afram's knowledge in the cheese side and the creation side is second to none. You cannot get somebody more experienced than Afram. And then you add Craig with his culinary expertise. You know, people forget, you know, Craig is corporate chef to companies like BMW. He was also on the Food Network. I sent you his bio as well. He was on one of their chef programs. But Craig knows how to execute the recipes, the products and recipes, and understanding how people use the products. So, you know, you can't ask for more than that in terms of market potential and a business potential in an industry that's on fire. It's a once in a lifetime kind of opportunity, and something that we could just personally, I could just never pass up. So
you know, so it's interesting because essentially, you know, again, going back to the idea that, let's say, just the butter part of is butter by itself is you know, a staple product. It's used in everything. Like, you know, from, you know, everybody uses butter, right? So then you have the cheese lines. So I guess the question is, and which David is asking. Okay, so he likes the concept, he likes the people. So what are the projections like? How much can you generate in terms of sales with these 6 products as a starter?
Yeah. So when it comes to numbers, and I would just say we're at the beginning, so it's not something we're going to get into projections. The butter literally just launched, I think it was 2 weeks ago. So from an investor standpoint, the only thing I'll say that they should be super excited about is you're coming in at the beginning. Like, it's only up from here in terms of the products that are going to be launching. You know, Afram and his team have been speaking to, you know, multi-unit operators on the restaurant side to utilize the products. You know, Afram highlighted some of the products that we have already in the pipeline that we'll be launching very soon, plus the additional ones that they're putting the finishing touches on. Like, it is only up from here in terms of potential. And so one thing I do want to highlight too, you know, we can touch a little bit on this, and this also leads to Afram's, you know, connections in the industry, and why I was so excited about it is, you know, I know what's going on in the plant-based sectors in terms of consolidation. You have the big multinationals. Saputo just announced an acquisition of Boot Island Foods. Boot Island, for people who don't know, is a Scottish producer of a product brand called Cheese. It's a brand that we carry. They acquired that in another company for 150 million. Danone, everybody knows Danone, billion-dollar conglomerate, acquired a company out of California. It was a private-based transaction, but a company we know very well, Earth Island Foods, huge in the plant-based food space. Danone has shown a massive interest in growing their plant-based potential and want to be deriving, upwards of $6 billion a year in plant-based sales in the future. They've acquired numerous companies that we carry in our stores, and Afram knows as well. And when you talk about connections in the cheese industry, who better than the person who is one of the largest importers and purchasers of cheese in North America, being Afram? So when we talk about the connections and the people who are speaking to these companies all the time, and we talk about the potential for the brand in terms of whether, and I've said this before on the Organic Garage side, we have an avenue to grow the business organically or potentially become an acquisition target. It is no different than the future of cheese side. And I saw that potential very early on. We have the potential to grow the brand ourselves domestically, nationally, and then internationally, or we have the potential selectively to look at potentially being acquired in the future by companies that Afram speaks to all the time. And so Afram, I don't know if you want to touch on that, but I think it's very important for investors to understand.
Yeah, I think to reiterate what Matt was saying, I mean, look, in Canada, we have Saputo, we have Agriper, we have Parmalat. In the US, there's Atalanta, those big dairy conglomerates. And their job, and this is what I've seen in Canada at least. Look, I know the Canadian market very, very well, the US as well. But these big players, these multi-billion-dollar importers, they're making product domestically. They don't want to or have time to go start from the ground up a company like this, and they're just going and buying one after one. You see it with those small artisanal dairies in Ontario, Quebec, and British Columbia. I see it every day. We're a big, big client of Saputo, Agriper. I mean, we're not on their radar. I'm talking to them daily because I'm placing orders with them. So, and I have their support on everything I do, and they're proud of everything I do. That's what's happening too. I mean, I think what Matt said is a great kind of point. And we're at the ground kind of floor with these products. We have a bunch ready to go. They're selling well. They're getting received well. This is what happens, is that the big guys come, and, if it works for them and it fits for them, fits in their portfolio of the rest of the products that they're offering, that's what's happening, right? And those like $100 million, $200 million acquisitions are happening in Canada all the time in this field, like in the dairy field.
Okay. So actually, interesting. Somebody's asking an interesting question. Okay. So question about how do you scale the, okay. So how do you scale this? Now, I guess he's saying, is this like, for example, with the brie, is this an artisanal product, or can you truly scale this? If, let's say, can Danone or somebody else, turn this into a $10 billion a year business?
Yeah, absolutely. I mean, right now we're making the product, and we're going to scale that, and we have a lot of room for growth just doing it ourselves. But discussing and kind of getting to that next step, 100%. These are handmade, hand rolled for now, right? But that technology and that kind of, this brainchild of mine is exactly that. It's 100%. And to work with those bigger people, 100%. So these are products right now, they're made artisanally, but can 100% scale. That's no question. And it's just like bries and camemberts, these camemberts that we're talking about in Normandy, there's thousands and millions being made, monthly. This is very much a product designed to make and to sell in that fashion as well. I hope it's tomorrow. Who knows?
Here's a great question, which is, okay, what is the plan to get the whole product line into thousands or tens of thousands of retail stores across the U.S., Canada, the world, maybe even France, right?
Yeah, the plan right now, we're doing a domestic launch. Ontario is the most populous province in Canada, so using our existing distribution channel, and we can touch on that as well, through the Cheese Boutique, we can access the majority of retailers in Ontario. So we're going to do a domestic launch, then we're going to focus on a national launch, and then we're going to focus on an international launch, and that includes the US and places like Europe. Because I've said it before, plant-based transports so well. So you don't have to worry about, like I said, with dairy-based products and issues of quality and things like that. Plant-based can be produced domestically and shipped internationally. So the potential is just huge. I can't stress it enough.
And
so yeah.
And I think to talk about the team, Jack, Matt mentioned, Craig Harding, who's the co-founder, also a very, very dear friend of mine, one of the best chefs in this country, easily. Matt is, a very smart guy, understands volume, understands scale. Everyone has their strength. And, I think the questions here on scale are fantastic. And really, I'm leaving Matt to do that. Because for me, my job is to take care of this product, perfect it, get it the best it can be, so it can travel to the US, it can travel to Europe. This product can do that. And the thing with cheese is, Jack, I have cheeses in my cheese cave right now that are 15 years old.
Oh.
With cheese, patience is very important. And whether it's plant-based or whatever kind of cheese, patience is very important. And for me, my business is 51 years and we celebrated our best year ever. This product, this is what's going to happen. I mean, patience, and I'm very proud of it. Business is a marathon. It's not a sprint. I've always felt that. And for me, it's getting better. It's perfecting the quality. It's getting more SKUs. I'm thrilled with the quality. I'm thrilled with the number of SKUs, and we're not done. And I think everyone on the team has their kind of, scenario in which they're involved in the company. And that's mine, is just to baby this thing and to take care of it, because cheese needs to be put on a pedestal. And it can't just be made and like thrown away and that is it. That's not the case. And in terms of scale, I just thought to myself, I'm looking at this cream cheese, okay? There's a lot of bagel and cream cheese eating in this continent, okay? In Canada and New York and Montreal. If we took a 0.2% of that volume, I'd be a happy camper of our plant-based cream cheese and bagel. The volume potential here is massive, massive.
Yeah. So just going back to your point on scalability, look, all the recipes have been designed to scale. There's nothing that is artisanal in nature that can't be reproduced on a mass level. And from a rollout perspective, we're going to be cautious because we want to make sure that the quality and supply chain is there. And like I said, we're focusing in the most populous province here in Canada first. We're going to do national, then international. So it's going to be a measured approach, but the beauty about this business, Jack, we touched on it. It's a little bit different than bricks and mortar grocery stores, but the ability to scale a consumer packaged product is much different than a brick and mortar business. And so the scalability of the company can happen very rapidly. For us, it's about being controlled and staying in control, making sure that the product's being put in the right retailers, and that we can measure and handle that kind of volume going forward. But it's been a great rollout so far. And Afram's right, there's a lot of SKUs in the pipeline that I'm super excited to get into the market. And then, the sky's the limit.
Okay. So, but in terms of how fast can you scale this up? In other words, somebody made a comment, which was about 50, you have a cheese that's in the cheese cave 15 years. We're not gonna have to wait 15 years for this to explode, right? I mean,
no, of course, no. I'm exaggerating.
Yeah. Right.
Well, I'm exaggerating, but I'm also not. I'm gonna have a product in that 15-year provolone. I'm gonna have a product that nobody has on this continent. That I will forget the continent, even in Italy where it's born. I'll be able to charge whatever I need to, whatever I want to for that product, because that is a unique product. My whole point is to become what it is. To become what it is so we can all enjoy it. In terms of like dates and timing, you know, we're not going to wait 15 years. I promise you that. Okay. But, you know, I think Matt kind of like even said it. I mean, it's not going to take long. We're already selling product left, right, and center. Toronto has received this thing very well. Toronto, the 5th biggest city in North America, is loving this. We are distributing the product right now. This is what we do for the last 50 years, is distribute product to the best wholesalers, other retailers, chefs, and hotels in the city. We already have it outside of Toronto. So it's already happening. In terms of scale, maybe Matt, you can kind of talk about like, you know, what you see in the near future.
Yeah, look, like I said, the beauty about the products are the recipes were designed to scale. And, you know, I just want to remind people that are watching, we just launched the butter 2 weeks ago. So it's easy to look ahead. All I can say is that we have more products coming out. And Afram's right. People forget Toronto is the 5th most populous, you know, city in North America. It's a big market. And so we're growing it here, you know, locally very quickly and to dominate domestically. And then we have plans for a national launch, you know, sometime next year, and then start looking at opportunities in the US. We have some you know, exciting announcements that I think will help outline kind of our strategy around US and international expansion with some expertise that we're going to bring to our team to help us get prepared for that launch, that I think people, you know, should be watching for, that I think will answer some of those questions. But you know, Afram said it, and I'll agree as well, is that products were built for scale, and you can scale a consumer packaged product line very quickly. And so for us, looking towards early next year, you know, that's when we're going to start looking towards what opportunities are available to us to rapidly grow the brand.
And just to clarify, next year means basically the next 3 months, because next year is you know,
we're coming to the end.
So,
yeah.
So the next 3-4 months, you're going to start going, because again, like every consumer brand, whatever, you know, food brand, you know, everybody starts off, you know, regionally, then they expand, then it goes, you know, maybe global. But so right now you're in, you know, Toronto, which is, you know, a good place to start. And from there, you're going to go national in the first quarter, basically, the next couple months.
We're going to be looking towards that, yes.
Okay.
You know, you are right, because we're near the end of this year. Forget about, you know, that fact. But yes.
And what about the U.S.? When do you go into the U.S. market? Because it's only an hour away from you, you know, Toronto. It's not a big deal.
It's not a matter of distance. It's a matter of strategy. The U.S. is a very big market. So having a good strategy and working with good partners in the U.S. to grow the brand is very important from a broker and distributor side. But like I said, you know what, it's important that everybody understands is that we are taking into account the U.S. market very seriously. And I think some of the announcements that we have coming up very soon will help speak to some of that about, you know, our direction as a company and how seriously we're taking that opportunity.
Okay, so let's wrap up on this note. Okay, in terms of milestones coming up, like what can we expect from? And again, I want to keep the conversation just focused on the branded product side of Organic Garage, whether it's you know, Future of Cheese, whether it's, you know, you want to talk about Kitchen Originals, but just in terms of the things that can scale branded products, what milestones are coming up in the next few months? What else? What's in the pipeline? New launches, new distribute. What do we have to look forward to?
Definitely new launches. So that is the focus. And for anybody that knows consumer packaged products, it's all about launches. It's all about new SKUs. So I think that is in the pipeline. And I think you'll see some exciting announcements about the direction of the company and how seriously we're taking the opportunity for the US market. So I'd say stay tuned for some of that news, because that's going to be coming out shortly, and gearing up the company, you know, to capitalize on the opportunity that exists. Because like I said, you know, the products speak for themselves. The management team, you guys have got a small taste of the expertise that Afram brings to the company, and his passion that you know, for me is just second to none. So yeah, so very exciting for kind of the short term, for the news that's coming out.
Okay, excellent. So on that note, I want to thank you guys. Thank you, Afram, Matt. And we look forward to getting you back with the next exciting news, whether it's products, distribution, etc., so that we can see Organic Garage, potentially become our next, 10-bagger. Oh, here's the cheese.
Thanks a lot.
That's the brie. That's it. I love this.
Thank you, guys.
Thank you, Jack. Thank you, Jack. Thank you.